Good afternoon, I guess good morning to some out west. Appreciate the time to speak today about BMO Insurance, and specifically we're going to talking about our whole life product. Hello to those of you that have met me before, some of you that may have not. My name is Zack Friedmann. I'm the Business Development Manager here in Ontario. I encourage you to take down my contact information for those of you in Ontario, or even those of you who are not. I'd be happy to connect you with your business development manager in your region. I know I pride myself in being available and reliable for the advisors I work with. Also love rolling up my sleeves and getting into casework. So please reach out. And if you have any questions about the presentation today, or you have a client that you think might fit for our whole life solution or any of our plethora of products here at BMO, also have included the QR code for my LinkedIn profile there if you want to connect there as well. So feel free to pop that open and add a connection on LinkedIn. I know COVID's forced us to all use LinkedIn for restaurants and for other things. So it's nice that we can use it in our industry now as well. So just a quick overview of what we'll be going through today. As I mentioned, we're talking about our whole life product here today. We've had a lot of success with our whole life product over the past few years. We're going to be just touching on some key features, talking about our product just at a glance, and then diving into some intricacies of it, which make it such a simple solution, yet effective to help grow your business. And then we'll show you exactly some real life case studies on how we've been able to win some cases with our product for some of our advisors we work with. And hopefully that can translate if you see a client that fits in your profile as well. And yeah, so we'll jump right into it. So our whole life product is a non-participating permanent life insurance plan, which focuses on an increasing death benefit. So it really is a simple solution, chocked full of guarantees with many flexible options built into it. So we have guaranteed cash values associated with it. We have 3 different guaranteed premium payments, whether that be 10, 20, or 8 to age 100, all at a level basis. As I mentioned, we have that increasing death benefit, which is accomplished by our performance bonus. Our performance bonus is made up of our performance bonus rate and our guaranteed cash value, which I'll get into later in the presentation. So as most participating whole life companies announce a dividend every year, we announce our performance bonus rate. So really the design of this product, we tried to take the success of some of the intricacies of a par product and incorporate that into our non-participating whole life product. So I know my boss and some of us like to joke around, we're considered a non-par product, but we look, smell, breathe exactly like a par product. So really the focuses on our product are simplicity, guarantees, and the flexibility. So I'll be focusing on that as we go through the presentation today. So with our product, we have one whole life product, but we have 2 different options. So we have our estate protector, which just like it sounds is focused on the estate and the back end. And then we have our wealth accelerator product, or a version option of that product. So 2 different options on that same product. And we do have all of the same features on both plans. They just have different fits, which I'll touch on in a moment. But as I mentioned earlier, same guaranteed premium payment periods, 10 pay, 20 pay, pay to age 100, where our product is chock full of guarantees, high guaranteed cash values. We have reduced paid up values and options available. We have our guaranteed bonus, performance bonus formula, which I will touch on in a moment as well. And then from a flexibility standpoint, lots of flexibility with our APO or additional payment option and the ability to go into premium offset. I will spend some time talking about that later in the presentation. And it really, our product shines in negative or alternative or adverse scenarios. So I'm sure a lot of you, if you weren't doing already, you're doing now, running your whole life quotes at a -1 scenario. So stress testing it, right? Our product, due to the design and some of the intricacies in it, look very well at a -1 scenario when you're comparing the difference between current and -1. So we'll talk more about that as well. And then from a commission standpoint, whether it be the estate or wealth, it is the same commission on both products. So in terms of the differences and where we've seen them fit, I know IFAs and ICFs are a very popular concept in the industry these days. That's really where our Wealth Accelerator product has been effective, generating those high early cash values to have as much leveraging as possible on that. some of you that are in that space, you're familiar with that, others that are not. We can dive into that more offline as well. It has that earlier break-even point where that's effective with those solutions, right? So when the cash value exceeds the total deposits is where you want the break-even point to come sooner if you're using it for leveraging, or higherly cash values are important, right? And on the other side of things, our estate protector product has been used for great solutions, whether it be a corporate asset transfer plan, any estate planning and insured retirement plans, or corporate insured retirement plans. It's been effective there as well. So really the focus there is on higher long-term cash values. It normally does buy you a higher initial face amount with when you're looking comparatively at the same premium compared to the wealth and the estate. The estate will buy you that higher initial face amount, and it's really focused on the high long-term death benefits. So that's kind of the difference of the two. I know most companies have introduced each version of their own product, which fit the similar mold, but just wanted to touch base on that quickly. From a target market standpoint, this is really where we've seen the most success in our product. I think our product is very flexible and unique in the way it can tailor to many different audiences, but I have found our target market is normally ages 40 to 65 is where we really see it shine, especially in the affluent market. We've won a lot of large cases recently, and I'll touch base on some of the reasons why later in the presentation, but we've been able to help minimize that impact of taxes for corporations or individuals on the back end, maximize those estate values to really help with the estate transfer process. And it's become a great alternative in their portfolio, whether it be for retirement income or just growth as a whole. From business owners, again, as I mentioned, from a corporate asset transfer process, we've been very effective there. A low cost of life insurance without tying up that capital in the policy. So what we've been effective with that. And then, as I mentioned, it can help with the retirement on the back end as well for business owners. So not to say this isn't where we've been successful, but we definitely have had more success, I would say, on the initial screen. But we do tailor to the young professionals. It's great for a permanent solution, right? Lock in the insurability at a younger age. You have it paid up maybe before you get into the heart of your life when you start having kids and such as well. It's been a great solution for that. You can add some term riders. I know the layered solution has always been a popular one with young professionals. For young families as well, great for debt and income protection. And then we do still operate in the juvenile space. So it's been awesome for some parents who have that excess capital and they want to lock in insurability for their clients on a 10-pay or 20-pay basis, get that paid up, and then hand the policy over to their young child once they turn of age. So that's kind of painting the picture of exactly where we've had success there. Just at a glance on our product, issue ages are from 0 to age 80. We have our single and joint last to die option. Uniquely, we can go up to 3 lives on a joint last to die. Obviously, you don't see that every day, but it is there if you need it on those unique situations, whether that be 3 partners looking to help on that corporate side of things. From a face amount standpoint, we can go up to 20 million for ages over 18 and up to 10 million for juveniles. I will note those are just our quoting software limitations, so to speak. We do have the ability of stretching those out and going a little bit further. We can ask for special quotes. If you do run into those ultra jumbo cases where you have clients that want or need more than that face amount, so reach out to me or my team here if you have any cases like that, right? And from a policy administrative fee perspective, there is a $50 annual fee, which is factored into the minimum premium quoted on the software. So we'll dive right into the premium pay options and go into some of the intricacies of our product. So as I mentioned, we have our guaranteed 10-pay, 20-pay, and pay to age 100. Obviously, the shorter the payment period, the more expensive the policy is going to be and the more capital it will require. But normally, the quicker you get that money into the policy, it can increase those values and get growing, right? The best part about our product is guarantees from a payment standpoint, regardless of what happens with the performance bonus rate, the policy is still going to be paid up in that duration, right? On a 10-pay or a 20-pay, it's always going to only be that 10 annual payments or 20 annual payments or monthly for 10 or 20 years. So the clients and advisors have loved that part of it. Regardless of what happens, your values, your death benefit may vary in a way depending on the performance, although it's been pretty stable, but the payment period is always guaranteed. And obviously that coverage continues for life. So the simplicity of those payment periods has been quite effective. In terms of simplicity, it also translates to our performance bonus. So the ability to easily explain exactly how our product works has been very effective with advisors selling our product. So I know for some of you here, you've sold traditional PAR in the past. You may have clients that want to know every single detail of the contract. You may have some that, oh, the values look good, the solution sounds great, that's fine, let's go with it, right? But for our product, we pride ourselves in you being able to explain to your client all of the moving parts. So our performance bonus, which as I mentioned, is like our dividend when we're comparing it, right? So our performance bonus is simply the performance bonus rate that we announce May of every year. It's currently at 5.5%. And then we multiply that by the guaranteed cash value laid out in the illustration. So in that contract, plus any additional payment balance equals the performance bonus. So that performance bonus is basically what it does is it buys paid up additions to increase the death benefit. And I'll go into that as we move forward through the presentation, but the simplicity of it, right? You can go from left to right on the illustration and explain everything. This is how we got to the value, calculated each policy anniversary, and the performance bonus, as I mentioned, is declared in May of every year. And we do guarantee it will never be negative. So again, for comparison's sake, when we're comparing to a traditional PAR whole life policy, that is normally the dividend formula that you would find. I know that's not something that you'll share with your client. I'm sure a lot of you cannot make sense of that. So really what we try to highlight here when we're comparing the two is the simplicity. Our formula is something that you can explain to your client, no problem. When you compare it to the alternative, it's very difficult to explain, right? I know we've all heard it referred to as kind of a black box. You don't know what's going on inside and it spits out a dividend, right? We've prided ourselves in the transparency on our product. So with that being said, we've also taken out less or more variables in our contract. So on a traditional PAR product, you're factoring in expenses or mortality lapses, regardless of what happens in those periods. Like that could all affect the dividend rate that they announce, that's being announced, right? So with our product, we've already factored that in. We've guaranteed any mortality lapses, expenses, anything that happens there has zero impact on the performance bonus that we announce. It's only the investment experience only. So because ours is only the investment experience, it makes sense to spend some time on that. And I am going to touch base on that as we move throughout the presentation. But again, we're trying to eliminate all variables in the contract, or as many as possible, to really simplify that. So I did touch on this earlier when I was highlighting the product, sorry, but our product is less sensitive to adverse scenarios. So again, if you're stress testing your solution, you're running it at a -1 or -2 scenario. And if you're operating in that IFA space or some of those other spaces, you're required to show the -1 because lenders are going to want to see that. How does it react to alternative scenarios, right? So our product, this is an example for a 50-year-old male non-smoker with 50,000 annual deposits over 10 years on our guaranteed 10 pay. So when we're comparing that to the current scale of our product and some of our competitors, and then at a -1, what that percentage is referencing to is the difference in total death benefit. So obviously, -1 is a significant drop. Our product and several other products, their dividend or performance bonus rate isn't going to drop -1 overnight. If it does go -1, it's probably going to be more of a slow, steady decline. But it's important to note to your clients, look, if things go south or it doesn't perform as well as we want it to, it's only going to have a minimal impact on your death benefit, right? So it's a much easier conversation for you to have with your client when obviously there's a smaller spread at the -1 scenario versus when there is a larger spread, right? So it's pretty significant when you look at year 20, age 85, and year 50 on the difference between current and -1 from a death benefit perspective. And the same is applied here with the Wealth Accelerator. So the first one there, sorry, was the Estate Protector. The same thing applies with the Wealth Accelerator, again, on that same 50-year-old male, 50,000 10 pay. So Important to stress test your solutions. And again, we look very good in those scenarios. There's less of a discrepancy. And the reason for that being is A, our investment strategy, and B, also the previous couple slides where I mentioned it's only the investment experience. There's no mortality lapses and expenses. We just have our investment experience. So again, because there's less variable, less moving parts, we're able to accomplish a lower spread with that. So in terms of our performance bonus rate, it is at 5.5%, which was announced May of this year, as I mentioned. Really what factors into this is we take into account the rate of return of our portfolio of fixed income investments and enhanced equity investments. So we're investing in long-term corporate bonds. We're taking a portion of the yield from those bonds, participating in call options within the Canadian and US marketplace. So on the TSX 60 and the S&P 500, we're buying options in the 100 least volatile stocks or options in those portfolios. So again, because we're already using the yield to buy options with that, the client's principal is protected, right? Because we've already made gains from those long-term bonds. So that's kind of how we're accomplishing that. We also have a smoothing formula, a 5-year smoothing formula that helps reduce the volatility with that. We're confident in who manages these investments. We have a great team behind us with BMO Asset Management and BMO Capital Markets. It is guaranteed to never be negative from our performance bonus. I will show you the history of that in a moment, but we use that performance bonus rate to calculate our performance bonus. It is credited annually, and I mentioned the formula earlier. So with that being said, this kind of gives you more of an idea of a flow chart. So again, we are buying those long-term corporate bonds as soon as the money comes in, right? We're buying them on a laddered approach. So we're not, say, buying all 30-year long-term corporate bonds. We're buying 10, 15, 20, 25. So it's laddered. They're not all, we're not getting the yield of that all at the same time. Then we normally take about 30% of that gains we make, and we're participating in the enhanced equity call option market, as I mentioned. So we have some upside potential there. But again, the client's principal is still protected. So that other 70% that we're gaining from those long-term corporate bonds, we're putting right back in and buying more of them. So we consider that, and BMO Global Asset Management has considered that some of the most secure investments. And because they are such long-term corporate bonds, we feel quite comfortable with that. And then with that being said, there is a smoothing formula that goes into that. And as I mentioned, we're at the 5.5% performance bonus rate. So, yeah, I mean, really, we're quite confident what we've been able to achieve and maintain from an investment strategy. Again, I'd be happy to have more of a conversation on that with any of you individually offline. We have a lot more information on our investment strategy that I'd be happy to share and have more of a conversation about that. But this just gives you a history of our performance bonus rate. Again, I know when I talk to and work with insurance advisors, they consider the whole life product to be a very conservative part of the client's investment portfolio, right? You're not trying to blow the lights out with your insurance solution. You're trying to have a very steady ride. You don't want a bumpy ride. We've tried to accomplish that with our performance bonus rate, right? We've maintained right around 5.5 to 5.75 throughout the contract, and we feel pretty confident that we're going to be able to continue and maintain with that. So that was our investment piece of that and how we basically can accomplish the performance bonus rate, and just kind of a broad overview of that. Now I will talk about some intricacies in our contract. So we do have our paid up additions that happen automatically. I know with some other contracts for paid up additions, they're not necessarily guaranteed, and you do have to elect when you want to use them and not. With our contract, the performance bonus is automatically buying those paid up additions, which increase the death benefit, right? So yeah, it doesn't require any additional premiums once you've already had that addition of that paid up additions, and I'll make mention of that as we go forward. And that just increases the total death benefit, as I mentioned. So from a total cash value standpoint, we have our guaranteed cash value, which is guaranteed in the contract. Then with that guaranteed cash value, we're multiplying it by that 5.5%, and then it's buying us a paid up addition cash value. So that paid up addition cash value is, with the guaranteed cash value, is their total cash value. So there's two columns equaling the total cash value. But with that paid up addition cash value, it's automatically buying paid up addition death benefit, which in the end increases their death benefit. So kind of works twofold from that standpoint. Now on our APO section, the additional payment option, I know some of you that are familiar with whole life and the intricacies of it, some companies call it an ADO, additional deposit option. I know there's some other names for it. Ours is an APO. So basically, for those of you that don't know what this is it's an additional deposit room that's available in addition to the minimum premium that's required. So that minimum premium that's required is already factoring in cash value and growth, right? But then we offer an additional room and availability to make premiums over that amount. So again, it helps accelerate the death benefit, and the cash values increase both of that. It does qualify for that performance bonus every policy year. So it really just supercharges some of the values and benefits. It is available on our 10 pay, 20 pay, and pay to age 100. One thing that's a huge piece from our APO, it's one of the most flexible ones on the market. The client can stop and start their APO at any time throughout the policy. So for example, if you have a client that says, yep, I'm putting in say 25,000 for 20 years on a 20 pay basis. I have an additional say $5,000 a year I can put in for APO. I'm not sure if I can commit to that at first. No problem. 5 years down the line, they decide they want to put it in for 5 years straight. They can do that. They can stop again. They can even do that 50 years down the line when the policy's already paid up. So the flexibility of that is endless. You can illustrate some different scenarios of that on our illustration software. So please reach out to me. I'll help you with that. But again, the client isn't forced to make that decision right up at front. Yeah, they want APO. They're committed to that. No, they don't have to make that decision. It's available at any time. And the key to this, there's no underwriting that's needed. I know some companies do allow that, but they will require the client to go through underwriting. We will not. So take advantage of that. It's definitely there and available. Another part of that, we do allow you to add term riders for single life only on the contract, and it will increase the APO room. So again, because you're increasing the overall death benefit, it's increasing the MTAR room, which is increasing the APO availability. So on our 10 pay, for example, you cannot have any APO for that first 10 years because we're using all the room to pay up the policy as quickly as possible. But when you add a term rider on that, it creates more room. It's available day one. So our APO is only available on our 10 pay without a term rider at year 11 onward. With our 20 pay and pay to age 100, there is more APO room there. So again, really confident and feel strongly about our APO. It's one of some very large cases, and you can be very successful with that. And just from a comp standpoint, it's 4% commission on the APO as earned as well. So again, if your client decides to do that after the payment period, you'll receive the 4% commission on the APO as well. So just a quick outline here on exactly how the APO works. So the additional payments are above that guaranteed payment. As I mentioned, there is that annual maximum. Important to note, if they don't use it in a single year, it doesn't carry over, it restarts. So if it is 5,000 one year, they don't use it, it doesn't go to 10,000 the next year. It continues over to 5,000 or whatever it may be. So that's important to note as well. The APO is automatically buying those paid up additions, as we mentioned, and they're added to that death benefit annually as the performance bonus is announced, and provides more upfront cash value and death benefit. It's always an interesting exercise to show what it will look like with all base premium versus say half APO, or you can play around with it to see what values you think would entice or is best for your client. So with the APO, obviously allows premium offset for those of you that are comfortable and familiar with whole life. So because we're supercharging the policy, so to speak, it allows us more flexibility and options to have the policy paid up quicker, right? So paid up addition value and the additional payment balance, those all can be used to essentially prepay the premiums. So after 5 years, the client can request premium offset as long as the policy has enough money in there to essentially fund for the rest of the duration. You do require an in-force illustration to do that, and there is a premium offset request form. It does allow you on our software to illustrate it, but it is a little bit more conservative. Normally, you can only illustrate it, say at year 9 on our 10 pay and year 11 on our 20 pay and life pay, depending on how much APO you have in there. So I think it's important to note it is an option that's available, but from what I've seen out in the market, I think sometimes it's illustrated a little too aggressively. And I mean, it's important to know it's not necessarily guaranteed, because the offset that's being illustrated and solved is based on the current dividend rate or current performance bonus rate, which isn't necessarily guaranteed. So if a company decreases their dividend rate, then it maybe kicks out another extra year of premium that the client has to pay before they get into offset. So again, this is a huge feature on why our guaranteed 10 pay works so well, why people love our 10 pay so much, because you're decreasing the uncertain period essentially, right? So if you do a life pay with premium offset at year 11 compared to a guaranteed 10 pay, which is essentially the same thing, only 10 premium payments, the 10 pay is guaranteed. Regardless of what happens to the dividend or performance bonus rate, it's going to be paid up after 10 years. With the life pay offset at year 11, there's so many years room left there for us to require more payments or another company to require more payments, because it's not necessarily guaranteed. So important to keep that in mind, I think, when we're talking about offset. Now, with our APO, I just wanted to kind of show you the impact it can have a little more visually. So it does increase the total cash value. So if we look here, right? So we have our dark blue column here, which is the guaranteed cash value. So that is specifically just the base guaranteed cash value on the contract. And then what we do is we have the paid up additions cash value. So this additional payment balance that the client's putting in every year is significantly increasing the paid up addition cash value. So in sense, what that is doing is buying more death benefit as well. So I'll show you as we go forward here on this couple slides, it does increase the death benefit. But important to note that with that APO, when premium offset's available, it definitely reduces the cash value when you use offset, sorry. So again, the APO increases the cash value, gives more room and more growth, but then when offset's elected, obviously it goes down because that's what's paying the premium options, right? So again, it is offsets available on our 20 pay and pay to age 100 after the 5th policy anniversary. You normally cannot illustrate that, but we have the ability to do in-force illustrations for policies that are in force. We allow a little bit more conservatism with our illustration software when illustrating offsets. So yeah, that's important to note with the cash value and how that affects it. But again, with the death benefit, it does significantly increase the death benefit as well. So guaranteed death benefit, just like the guaranteed cash value here in dark blue, paid up addition, death benefit here, and the light blue. So it's significantly increasing the death benefit. So that's exactly what that APO balance does, similar to what it did to the cash value. Same thing applies for premium offset, right? So the guaranteed death benefit is not going to decrease. It's going to continue to grow, but the paid up addition death benefit will decrease with that premium offset. Again, because you're using the value in there to pay for the premiums essentially, right? So I think that's important to note. So from a flexibility standpoint on our premium payment period, it is important to note that we do have the ability to change the premium options. You can essentially extend them. So if you have a 10 pay and you have a client that commits to a 10 pay, obviously it's a large commitment from a capital standpoint. If they determine, say, in year 2, you know what, the 10 pay is a little bit too stiff for my liking, can we extend the payments? We have the ability to extend the 20 to a 20 pay. Can also extend to a pay to age 100. A 20 pay can be extended to pay to age 100 as well. So again, we wanted to emphasize flexibility here in our contract. Important to note, you can't go backwards. If you have a client that you sell a 20 pay, they want to then do a 10 pay. Unfortunately, that's not available. But again, another tool for the client to have when they are committing to a large investment with the whole life policy. Excuse me. So when it's exercised, that premium payment is extended for the remaining number of years, depending on the new payment period, right? And the premium rates, of course, are dependent on the age at issue and that risk class. So important to note that that's available. We also have an RPU option for some more flexibility. The client has the ability to stop paying premiums, which would obviously reduce the insurance coverage. This is different from a premium offset feature, as automatically right away the insurance death benefit face amount, would be decreased because of this. So they have that option in writing. The coverage must be at least $5,000 for the insurance. So again, we'd have to determine when that can be exercised. Very important to note, it can't be reversed. So I would recommend exercising or exploring all other options before that. And the reduced paid up still does qualify for that performance bonus. So again, it still could increase minimally, but automatically right off the bat, you'd have a significant reduction in that. We have policy loans that are available. We will allow the client to borrow up to 90% of that total cash value, a minimum of $500. It does not impact the plan's eligibility for those paid up additions as well. From an interest rate standpoint, normally it's basically based on the prime lending rate, but bit of a gray area, and BMO Insurance is the one to determine that loan rate. So normally when a client's trying to get money out of the policy, depending on the amount, a collateral loan with a third-party lender might be the better solution. So we also have our special death benefit option, which is a bit of a unique offering. Again, may not work in every scenario, but it's unique in the sense that can help with costs that may arise on that first death. So on a joint last to die basis, always know that the death benefit's not going to pay out until the second life passes away. But when you elect that special death benefit, we allow on the first death, we'll pay out the additional payment balance or the total cash value minus any outstanding policy debt at 90% of that. So it is a unique feature to have. I know corporations sometimes will like to have that if there is costs that arise on that first death. So it can be unique there. It does have to be elected at issue, and it can only be selected when the APO is selected. So as I mentioned earlier, the APO doesn't have to be elected at issue to use it, but if you want this particular option available on the policy on a joint last to die case, you have to have APO elected at issue. And it is only available when both lives are insured or insurable. So when you have a rated case, it's not as available. So that's kind of where we're at with that. You can also add a lot of different riders to our whole life policy. We have term life riders, some unique terms in there, term 10, 15, 20, 25, 30. For those of you that aren't familiar, we also offer those on a standalone basis. So we have some unique term ratings which help with those unique cases. We have our living benefit rider available as well. So lots of CI riders that you can add on to the policy, 10, 20 to age 75 and to age 100. We have other additional life riders, as I mentioned, which can increase the APO room, a children's term rider, and then we have some other options available for riders as well that we can discuss, and you can see on our illustration software as well. With our permanent solutions, specifically our whole life, we do also offer BMO Insurance Health Advocate Plan. It can provide some amazing features for medical information and services. There is a range of teledoc medical services that you can use. It also is available for immediate family for unlimited access, and then your extended family has access to that once every 3 years. So for those of you that have clients that may not have family doctors, I mean, it can be amazing. Or even if they do have a second opinion, free of charge with their insurance policy as well. And then there is some other personal assistance services available through LifeWorks as well. We do have some compassionate benefit programs available within our product as well. Our terminal illness life advance, where if your client has been diagnosed with life expectancy with less than a year, we do have the ability for that one-time lump sum advance. It's 50% of the death benefit to a maximum of $250,000. So again, I've seen this do wonders for families who unfortunately are diagnosed with this and have this bad news. We also have the final financial hardship life advance. So again, if it's less than 5 years of life expectancy, we provide annual installments over the 5-year period. Again, up to 50% of the death benefit to a maximum of 250. So again, these things are important to note, not necessarily things that are highlighted as much as some product features and intricacies like premium offset and APO. But again, they're so important to note and assure your client that that is available if they need them. Just speaking on an overall standpoint here with BMO, for those of you that do business with us regularly, you're probably a little bit more familiar with this process. But for those of you that don't, we have accelerated underwriting, which is up to $2 million for ages 18 to 50 and up to $500,000 for ages 51 to 60. So what is accelerated underwriting? What this means is there's no fluids that are required for those two thresholds. What is required is a tele-interview. So a tele-interview from Dynacare will be needed for those age ranges, but you don't have to ask the medical questions on the application. There are no fluids that are required. I've had some interesting conversations over the past little bit of advisors that love the tele-interview because it puts the onus on Dynacare and the conversation is recorded. So there's no confusion. If the client said something but meant another thing, it's all recorded there. I've talked to other advisors that don't like the tele-interview because they feel like it takes a little bit of control away from them. But I tend to agree with the tele-interview. I think it's a great resource that we have. And I know there's been some bad experiences with tele-interviews in the past. If you have any of those with a BMO solution, please reach out to me or my colleagues here, because we have a contract with Dynacare to complete those tele-interviews. That's important. So again, we've used that to our advantage. You don't have to answer or ask the medical questions within that range because a tele-interview is needed. I think it's important to note, though, that if our underwriters determine that an answer in the tele-interview requires more information, they may request an APS or additional medical tests. So I know I've talked to some advisors who will emphasize that to their clients when they're selling the product, saying, no medical tests are needed. You just have to do a tele-interview. Yes, that's true, but I think it's important to also remind them if something comes up in the tele-interview that requires further investigation, the insurance company has the right to do so, right? So that's my 2 cents on that matter. But yeah, we do have some large banding for that. So makes it a little bit easier of an underwriting process for your client. So we're going to dive into some sales ideas, specifically the estate planning with high net worth clients. I know we probably have a wide range of people on the call today. Those of you who may not deal with the high net worth clients, but those of you that do, we have some unique examples here on how we were able to win some cases. So for those of you that maybe not operate in that space or hope to, this could give you some good education and information around it. So this is a real life case study that we won recently. So we have Carl and Kathy. They're both two very successful entrepreneurs. So really what their objective is, they wanted to have, or they needed to have $1 million of joint last to die permanent insurance. It was specifically for estate planning needs. They were adamant about paying off the insurance in 10 years. They didn't want the payments to continue. They wanted to make sure it was paid off in 10 years. They have $500,000 that they had set away for the insurance, and they made it clear they don't need access to those funds, right? So automatically, I'm sure a lot of you out there, you have the wheel spinning, your advisor hat on. Where exactly does this fit? Where does it go? Well, them saying they don't need the access to these funds, to me, automatically says, oh, well, maybe the estate protector version of our product might be best, right? Because we're not worried about those higher early cash values. They don't need it for leveraging sake. They don't need it for those higher early cash values. So that's kind of where we went. Really some areas where we were able to win this case are highlighted there. So we have our quick pay options available. We have our guaranteed 10 pay, as we talked about. We're able to diversify their assets. Because of the simplicity of our product, it was very low maintenance. The clients were rest assured that the investments and their money in the policy was managed by experts under our BMO Financial Group umbrella. and our product is chock full of guarantees. They did like that as well. So as I kind of alluded to on the previous slide, BMO was able to win this case with our Estate Protector 10-pay solution. We had the guaranteed premium payments over 10 years, as I mentioned. The money repositioned into life insurance policy for that tax deferred growth. So it was paid out or will be paid out on the back end as a tax-free death benefit compared to other investments. So they were able to diversify their portfolio there. As I mentioned on the previous slide, our assets are managed in partnership with BMO Capital Markets and BMO Asset Management. So they were very confident in our ability to manage their investments in those funds there. Our product is chock full of guarantees from the premium standpoint to the cash value and our performance bonus formula. So they felt confident in that. The advisor was really able to hammer home the simplicity of our product, was able to explain it in and out. The clients loved the advisor's ability to do that. And last but not least, don't forget, we are less sensitive to adverse scenarios. So at a -1, the clients liked to see that and made them rest assured that this is the right solution for them. So we'll show you exactly kind of how the comparison went here. So I know there's a lot of numbers and figures on the screen. That blue dotted line represents the BMO Estate Protector 10-pay solution. We're looking at a cash value standpoint. They did mention that's not necessarily as important to them, but I think it's still important to note that with these solutions, because in the end, that cash value is buying them more paid up additions, which are increasing the death benefit, right? So as you see there, at age 80, BMO Insurance Estate Protector had 2% more than Company A, which is that yellow line, which is the direct competition with this case. And then on the death benefit perspective, we had 10% more than Company A at age 80 with the death benefit. So again, we're comparing 10-pay to 10-pays here, and we were able to win this case. The client wanted a guaranteed 10-pay solution. Our guaranteed 10-pay is definitely looking like one of the most strongest products on the market from that perspective. So that's kind of how analytically we were able to win the case. So just to recap here, what this did with the $50,000 annual premium over 10 years, as I mentioned, they only wanted the $500,000 deposited over 10 years, gives us the $50,000. And this is exactly what it bought them. So with our product, it was able to buy them a much larger sum insured. You see here, it's pretty substantial, the difference of that. So from a dollar figure standpoint on the premium basis, $50,000 will buy them a lot more upfront insurance with us versus the competitors. And then as a added bonus on top, we do pay the best on the market from a FYC perspective with our 10-pay. So from a comp standpoint for the advisor, obviously it's not the end all be all. The best solution should be what's prioritized for the client, but we do pay the best from an FYC standpoint with our 10-pay as well. So that is one solution where we came out on top from the estate side. Also wanted to show you another real life case study here where we were able to also win the case. This one was a little different. The client wanted high liquidity early on, and they with that permanent coverage. So we'll take you into that solution. So we have Charles, a 60-year-old executive. What he wanted was $250,000 of permanent insurance. Wanted to lock in his insurability. He really considered the insurance as an asset class. So he wanted to use this to his disposal. He was very sensitive. He wanted those high early cash values. He prioritized that. He wanted the liquidity in the policy to take advantage of his future investment opportunities. And Charles was willing to commit $25,000 per year over the next 10 years. So as some of you are probably already thinking, we went in a different direction compared to our last case study. For this one was with our Wealth Accelerator. We really wanted to hammer home those high early cash values. So what we used here is ended up being our pay to age 100 with max APO with premium offset. So I know I talked in the past little bit here about guaranteed 10-pay and why it's important to have those guaranteed 10 premium payments. But I mean, it's important to remain flexible. Like with this solution, Charles wasn't necessarily identifying a guaranteed 10-year premium payment was the end all be all to him. He was open to using the offset method. He understood the small risk that might play into it, but he this feature looked best with, or this version of our product looked best for the value standpoint, what he wanted to accomplish, right? So that kind of outweighed the guaranteed 10-pay premium period, the higher cash value in early years, really what sold him. Again, just like the last example, strong guarantees on our premium, cash value, and performance bonus are really what Charles liked here with the Wealth Accelerator version. So a solution for Charles here, we had the premium switch option available for him just in case. So that was there. Obviously, with when he went with the life pay, it didn't necessarily factor in, but that kind of the flexibility led him to he was more open to the solution, I would say, with that ability. So, and then he liked the security with BMO Capital Markets and BMO Asset Management as well. So, as I mentioned in the previous example, less sensitive in those adverse scenarios as well. So, again, a lot of figures and a lot of values here on the screen. We compared this to other competitors on the market with the same pay to age 100 with max APO offset at year 11, so 10 payments as well. What we're looking at here is a -1 scale. So because Charles was going to use this for lending, the third-party lending for the cash value in the policy, thought it was really important to show the -1 and use the comparison sake for that. So as we can see here, that blue line of the BMO Insurance Wealth Accelerator product, we're looking pretty good early on here with these cash values. So just to pop it up open here, at year 10, from a cash value standpoint, at the -1 scenario, our Wealth Accelerator did look best. It was definitely close, like Plan A, even Plan B, Plan C, they all have great solutions available to them. But because we were able to get more cash value there, that was very important to Charles. It also is very important to note that when you compare the Wealth Accelerator to the Estate Protector, it does come at a difference, so to speak, right? So when we're looking at age 85, which tends to be life expectancy, we want to make it, the advisor want to make it clear to Charles that this is where we are at from a death benefit perspective. He did mention he wanted $250,000 in death benefit initially, at least. So we did lock that in for him, and it obviously grew as well. But we're looking at it competitively. Like Plan A obviously beats us in the death benefit space, even at a -1 scenario. But from a cash value standpoint, that's really what he wanted to go with. So that's really what led him to fix this solution. So I think it's important to acknowledge the pros in all the solutions, but also maybe where you come up short in other solutions. So that's kind of where we were at here. But again, because that wasn't a huge piece to him, this case won out. And just again, comparative sake from a initial sum insured and FYC standpoint, right? So we, with that premium duration, we did again buy him the most initial death benefit for that sum insured. And then from an FYC standpoint, we did look the best and paid the most comp on this as well. So those are two examples of cases that we were able to win and had some success there with them. So really wanted to highlight and bring that to your attention, especially on a -1 scenario where we really shine, especially that initial slide I showed you on where there is not much of a discrepancy, or yeah, it's a very small discrepancy from current to -1 on a cash value and death benefit standpoint, right? So I hope that got the juices flowing and showed you some good ideas there. Also wanted to reinforce, we're definitely here to support you, whether it be myself and the Ontario team, all of us across Canada, our team out west, or our team in Quebec and the Maritimes as well. So please remember, we're here to support you. We love doing casework and supporting you guys with cases. We do have a dedicated team across the country. We have some great resources on our BMO Advisor website. So with our Smart app, I'm sure a lot of you on the call have used our Smart app. Definitely would say it's one of the best in the industry from an online application standpoint. Secure, fast, and easy. I know those are things that I look for when I'm doing business with people of all different spaces. So give that a look. Got some great resources there. And then also from a marketing standpoint, I did talk to Lisa and Laura earlier. I am going to be sending out some additional marketing material for this product as well, with our performance bonus and some of our investment experience. So that gives you some idea and pieces that you can share with your clients as well to show them our investment approach, where we've had success. Also on our website here, bmoinsurance.com/advisor. That will take you to our homepage there where you can download our illustration software. The Wave version 49 was the most recent edition. That's where you can find all the forms, materials, marketing materials. We have different insurance concepts at your disposal as well. So lots of great material for you. Just to recap what we went over today, our whole life product, again, simple, flexible, guaranteed are the three pillars of our product. We are very passionate about the ability to easily explain our performance bonus rate and that performance bonus formula. I did emphasize it is less sensitive to adverse scenarios, running at a -1 or -2 scenario. Our APO flexibility is second to none. The ability to stop and start the APO without any underwriting requirements or anything for the client is huge. Adding that term rider to increase the APO on a single life basis also can be huge to help quick pay those policies. The accelerated underwriting when no fluids are required, and then the additional benefits from our whole life product and other permanent solutions as well have also been very effective for the clients. So again, in an uncertain world that we're going through these days, please turn to BMO Insurance, provide clarity and more predictability for your clients. And being backed by BMO Financial Group and that strength financially has really helped us as well. So just to recap here, we have our Ontario Regional Sales Office, Western and Quebec and Atlantic Regional Sales Office. If you don't know who your wholesaler is or your business development manager, please give that number a call and we'll be able to direct you in the right place. For those of you here in Ontario, I look after all of Ontario here with IDC, so please connect with me directly. And again, if you want to connect on LinkedIn, my QR code is there for anybody that wants to connect that way. But feel free to call, email, text. Happy to discuss any solutions you have or dive into our product a little bit further. So sorry, I didn't mention at the beginning of the presentation, if you do have any questions, feel free to pop them into the chat box there. I'm not sure if we had any questions come up. It's an interesting question on the life guide area because we're technically considered a non-par product, but we are compared, like from a value standpoint and comparative speaking, we compare to a par. I know with life guide, they quite often don't show us there. So if you're not able to see that there, I believe we are on life guide, but it may just be the specific area that or selection that you're putting in. So I would reach out to your wholesaler for a specific case. We're happy to run the illustrations and see how they compare. I know sometimes it's not as convenient using life guide, but I would say when you factor in the intricacies of a permanent product, I don't know if using life guide, you get the full detail of all products anyway. So that's a tricky one, but I would reach out to your wholesaler there. So another question here, do you have the specific APO amount at application time? So yeah, good question. On our illustration, when you run the illustration, it will show you the max APO right on the quote. So even though you don't have to elect APO at the time of application or time of policy, it still shows the amount, and that will be issued in the contract as well. So the client will know the APO amount that they can put in every year if they do want to do that. So that definitely is identified there. Had a question here about taxes working the same way in our product as in par life insurance. I mean, yeah, a short answer is yes. The tax consequences when you withdraw from a product are definitely the same as our product or any product really. So yeah, that still factors in the same as a par life insurance product. Another question here about may compare this kind of insurance with a universal life. contract. I mean, it's always an interesting discussion when I talk to different advisors. I know some advisors I work with love our universal life. We have several different presentations on our UL as well. We have lots of great options there. I think they're two different products and they both fit different needs. Obviously, we emphasize the flexibility with our whole life product, but a UL can be even more flexible from a stop and start premium standpoint. I mean, UL factors in for the minimum cost of insurance. There's no additional investments unless you're over contributing, right? With the whole life, the minimum premium is already factoring in growth and investments. So it's an interesting comparison. I think depending on the need, you can use that to compare to a UL as well. Yeah, I think that's really the gist of the Q&A. I appreciate all the kind words in the Q&A. I'll definitely be forwarding on a copy of this presentation and some great marketing material as well. But yeah, as I outlined, please reach out to myself or any of our sales team there, and we'll be happy to dive through things further with you.